every couple of months, it seems like everyone is going crazy over the interest rates going up or interest rates going down. Every time the Fed does something, the whole economy goes crazy. Everybody's always talking about interest rates this, interest rates that, but why does it even matter? What do interest rates do in the economy, and why is it so important what the rate is? Welcome to the Riggie Report. My name is Riggie, and on this channel, my goal is to answer all of your questions about economic topics. So if that is something that interests you, don't forget to leave me a like and a follow. So one of the most important things in our economy are the interest rates. So interest rates are the borrowing costs, and they impact pretty much all aspects of our economy, from business to finance to even your own personal finances. When interest rates are low, it's really good to promote growth. When interest rates are low, it helps people to be able to afford things. It promotes people buying, it promotes buying a car, buying homes, and just more consumption. It promotes consumption, it promotes economic growth. For example, let's say you're in the market, you're looking for a house, and you find your dream home, and it's $400,000, and you are just wanting to look at rates, right? All else being equal, if you buy that house at a 2% interest rate, your monthly principal and mortgage payment for the $400,000 house is only $1,478. If you buy that same house at 4% interest, your payment jumps up to $1,910. If you buy the same house at a 6% interest rate, your payment then goes up to $2,398. And if you buy the house at an 8% interest rate, your payment then goes up to $2,935. That is such a huge gap in interest. And the only thing that changed is that rate. The location stayed the same, the buildings stayed the same, the land stayed the same. The only thing that changed is the rate of which you're buying the property. So the difference between a 2% interest rate and an 8% interest rate is $1,457 monthly. That's why, if you guys remember back in 2021, when interest rates were down at 2%, people were going absolutely crazy, going feral, trying to land themselves a property. Because even though the property is even more expensive, with a lower interest rate, the payments are still really affordable. The payments are still really low. So that's for personal. When we look at for business, when we have lower interest rates, the businesses are more inclined to invest in their business. They're more inclined to go out and buy equipment. They're more inclined to go out and buy properties to expand, because borrowing is cheap. They can get loans at 2%, 3%, 4%. So it promotes growth in the economy because businesses are expanding. It promotes growth in the economy because customers are spending, because it's cheaper to afford products. It's cheaper to afford houses. It's cheaper to afford cars. However, when interest rates go up, things start to slow down. When interest rates go up, it becomes more expensive. So now, instead of buying a $400,000 house at 2%, now you're buying it at 8%, the monthly mortgage payment almost doubles. So now you have more out-of-pocket costs, and you have to think a little bit more before you start spending your money. When interest rates go up, it constricts the economy, so people pull back on spending because now it's more expensive. You have to think before you spend a dime. You have to really, really think about the house. Like, is it really worth a $2,900 payment for that house versus if you were just buying it at 2% when the principal and mortgage would only be $1,478. So when interest rates go up, people are more reluctant to spend. However, when interest rates are down, you're not making any money on your savings. It's harder to make money on your savings. I don't know if you guys remember, back in 2001, at the same time that people were busy refinancing, banks weren't paying anything at all. They're paying like 0.01% on their savings accounts. Some banks are still paying 0.01% on their savings accounts. But that's a video for another day. So it was really hard to make more money if you were just keeping it in your bank. The inflation was eating up the money that you were keeping in the bank, so you had to go out and invest. You had to go out and spend it somewhere in order to make a profit. versus when interest rates are up. Right now, you could get a CD for about 4.5%. So you don't have to go out and take a risk with your money and risk losing the principal. So now a lot of people are more inclined to save instead of investing, because when your money is working for you and you're not doing anything, even if it's 4 or 5%, some people are really happy with that. So that's why interest rates are one of the ways that the Federal Reserve really tries to control the economy. So when inflation is heating up and things are just going way too crazy, prices are rising way too fast, things are going way too high, the Federal Reserve usually, increases the interest rates to slow the economy down. When prices are too high, when people can't afford to live, like right now, when people can't afford anything, when people are really feeling the pressure of the economy, then they tend to bring interest rates down to try to get people to invest, to try to get people to go out and purchase more. When numbers are looking bad in the economy, that's when you start to see interest rates go down. I hope that answers you guys' question. Don't forget to like, comment, and subscribe, and I'll see you on the next video.